If you're a residential real estate agent earning $200,000 a year and you want to grow your passive income, this show's for you. Learn the secrets other agents use and hear from experts in our field in order to guide you along your journey to investing in assets like apartment communities so that you can turn your commissions into cash flow. I'm Randall McLeod. Let's go, baby. All right, welcome back. It's good to have you on for this week. We are bringing on John McManus. He is a real estate broker out in the California market, and he transacts industrial real estate. Guy's a powerhouse. He's been in the business for quite some time. He has, get this, transacted over $4.5 billion worth of real estate, over 550 transactions, over 52 million square feet. So he's put up some massive numbers, and he's a wealth of knowledge and experience. We do touch on the broker side of the business, the investing side of the business, and he also talks about what to do with your income in your career so that you are positioned well when you get later in your career. It's investing, it's saving, and that sort of thing. So take out your pen, take out your paper, take some notes. Really great guy, and you're going to enjoy this episode. As always, if you're getting value out of the show, please go on, rate and review wherever you're listening to this podcast. Helps me out a lot. And let's jump in with John McManus. Here we go. So why don't we jump in first, John, assuming I've done the introductions. Just go ahead and tell us briefly about yourself, where you are, the market you're in, and what you focus on.
Sure. I'm an industrial broker. I work across Northern California. I started in 1991 in the shadow of the Port of Oakland doing, 1,000 and 2,000 square foot deals. And at one point I was doing, 70, 80 small transactions a year, chasing my tail around. And over time, I've followed the containers really that come out of the port and work across Northern California. So out, from Oakland to Stockton, Oakland to Sacramento. And I have clients that I work with across North America and doing tenant rep work. Okay. I only represent product, listings in the close in Oakland East Bay. I'll partner with folks a little bit further into Central California, but for the most part, my listing work is here close in, and then I'll take tenants really anywhere across the world. Yeah.
So was there something early in your career? I mean, you're doing 70 to 80 transactions a year. That's quite a bit, right? And you said something that you follow them. Did you literally get in a car, follow a container? Like, this is where they're going. I need to...
No, not literally following them, although I did watch where they were headed. I mean, things have changed. A lot of the things that are happening 60 miles inland weren't happening in the early 90s. Distribution patterns have changed, obviously, and that accelerated, in sort of beginning in 2013, 14, 15. And so, no, it's just the business. And we used to have a lot of land here, close to Oakland and San Francisco, and to do new products and new projects and build to suit work, you just had to move further inland for the most part. So, no, I didn't literally follow them, although I have had people ask me, how long is it from here to there and what's it like? And there was a period where I was working with some clients that wanted to know, and I didn't really know, right? What's it like at 4 a.m? So, and then they would say, but drive like a truck. So you go out and you drive at 55 or 60 miles an hour in the commute patterns and see what it's really like. And it's actually an interesting way to look at the market.
Yeah. I would think that's what I was asking, because you really would get to know more about where they're going and what you're doing. So that's why I was curious. Okay. Well, you touched on something just now, and I feel like that's a good place that we can start. We can talk brokerage all day. I talk to plenty of brokers all the time, and we talk about investments they're making and all the different things that they're doing. But you had an interesting take on what you wanted to cover. And so why don't we dive into that and talk about looking back? You're at a certain point in your career where you can look back and kind of see what may have been, or, offer some advice to other people who are looking to, grow their cash flow outside of real estate. So why don't you take it there and kind of discuss what you wanted to discuss?
Right. And I assume, Randall, most of your audience is an independent contractor, right? Schedule C or some kind of entity. And that's really who I'm talking to. And so from the beginning, you work with the firm. And by the way, I work with Cushman and Wakefield. You may even see that on my Zoom. I probably should have changed that before we came on. These opinions are strictly my own and not theirs in any way. So anything that's wrong, the email comes to me. I started, and I've worked with a number of different firms. I've been lucky to be stable and be at Cushman & Wakefield now 22, 23 years. But I've always realized, and part of that was being at a firm one that dissolved its industrial division early on, and then Grubb and Ellis, I think, for the second and third bankruptcies, right? So you realize that you're an independent entity, and so your firm may offer you the opportunity to buy benefits, life insurance, disability insurance, and all those kinds of things. And I've always carried those myself just for portability purposes. And that goes to, kind of larger thinking about how you build your business and how you look at yourself as an economic entity, right? You have your own balance sheet, you have your own profit and loss, and you want to keep that portable. I've been fortunate enough that I haven't had to play that card and move somewhere else and do something different. But I think as you're a younger agent and you got to set things up, the day that the team that you're with moves to another firm, or the firm says, hey, we're not in this line of business anymore, you need to focus on your clients. You need to focus on getting out in front of your move and making that work the right way. You do not want to be on the phone with a life insurance agent, worried about your health insurance and those kinds of things. So that's just kind of big picture on where you are. But I'm in my mid 50s now, and this is a young person's business. This is a business, and one of the things that's really changed is that you're on now 24/7. When I started, I would come back in and they would have pink message sheets for me, right? And I would literally have pink pieces of paper that would have phone messages on them. It was totally fine to take 24 hours to get back to somebody. You had a roll of dimes in your car, you look for a payphone. The expectation was not what it is now. And the pandemic accelerated that even further. I'll tell you, there are days you get tired of chasing around like that. So you want to have the option. And the only way you have the option is starting earlier in your career, right? I'm not a believer in, doing one great investment deal and, you flip something and you get rich. It's a long, slow process. There are thousands and thousands of small decisions that you make along the way to get to that point. And so, I would say to those folks who are starting out in their 20s and 30s, start right away. And I had a client, his name was Sam Jenneberg, and he was one of the people that gave me a chance early on when I probably wasn't qualified even to do the work. He, I went up to his house to drop off a lease because we didn't do anything by email in those days, and sat at his kitchen table with Sam and his wife. And he said, you better save your money. He said, save 10% of everything that you make and pay yourself first. And it sounds kind of cliche, but you got to pay yourself first, even when you're scrapping to get things going. And then whether you choose to invest that money in real estate or in something else, at least you've got a little bit of a slug of capital to start with. And, in good years, I've tried to put more away. Obviously, that's part of it, because there are going to be years. And, if you look at, I'm on the industrial side, but you look at my colleagues and friends on the office side, and they woke up in March of 2020 and that market stopped. That market's, and it's still not back, right? So you can be on top of the world and making $1 million a year. There are market forces that are bigger than what we do. And so you want to be prepared for that. And it affects your business, right? There are two things I think that have really helped my business as I've grown. One is when you get to a point of financial stability and you don't need the deal. If the client needs the deal more than you do, you're in a great place. If you need the deal more than they do, they smell it on you, and you're not going to be credible, right? Because they know that everything you say is geared toward getting the deal done, and that's not where you want to be. To be good at this, you need to be able to say to somebody, "Don't do this. This isn't good. We're gonna step back. We're gonna reload. We're going to be delayed 3 months, 6 months, but it's the right thing to do." It's hard to do that when you don't know how you're going to make your next mortgage payment or rent payment. The other thing that I think really changed my career, I 6-7 years in, I had a broker who was, and this was a small firm, 10, 12 people. He was very focused on investment opportunities and actually lent me money to get into my first deal. And once you step into that ownership position and you're dealing with the insurance certificates and the lease clauses that go to the lender, you become a much better broker. I've no doubt about that, because you have an ownership mentality. You understand how, and you do in the CCIM classes and SIOR, and they all do a great job, but it's a little bit classroom. But when you start to understand, because you're sitting with your lender, how NOI translates into value, and what that means and what lease clauses might mean to a refinance effort, just changes everything. And the advice that you give just gets better and better. And so that was something else I think that was really helpful for me, in the relatively early days of my career, to make me a better broker.
Yeah, for sure. A lot in there that I want to go back to. So you were talking about starting right away, right? So starting right away, and then you alluded to saving. So putting some money away. There's a great book out there if you're just getting into this called Profit First. It's about paying yourself first and then allocating. It's a systematic way of doing it if you're running a business and you're not paying yourself. So we implemented that with some of our agents and some of the team that we had, just so that they were, again, aware. Like, put some money away, save some money for taxes. You're in this, like real estate 101, you're nothing's coming out for taxes, so you got to pay it yourself. So I agree with that. But what were some of the things that when you were early on and you were, for one, I guess, what was early on when you were the pink sheets? Are we 90s?
Early on was 1991. I came to California I was at a graduate school. I was in love with the beautiful girl who's now still a beautiful girl, my wife. And probably I don't make it to where I am without her. But, I had student debt. I burned my brakes down out on the backside of the Rocky Mountains coming from the East Coast to California. So started in debt and put on more debt, in the first 2 or 3 years. So it wasn't like, I was doing this right away. I sold, they used to sell the newspaper at night. So I'd go for my job downtown to a call center and try to sell newspapers. If you buy the Sunday paper, I'll give you the rest of the week free, I think was the rap. Yeah. And I learned as we went on that there was a bunch of guys there that were on parole. They didn't really need to sell papers, but they needed to have a job. So this place would stamp it for them. It was pretty interesting slice of life stuff. I painted apartments, picked up weekend jobs, did whatever. So I didn't have money like right away to do it. It wasn't an instant success. And the early 90s looked a lot like what this market looks like, right? There were office buildings. Nobody wanted them. You could give it to me, but I don't want to pay the operating expenses on some stuff. So it was a similarly bad market, which is a great time to learn, because you got to do the right stuff. Your phone is not going to ring and you're going to make a big deal. You need to block and tackle. So I was actually fortunate to come in at a difficult time. So I did learn early on that, I had to put the tax money away. So that was, that's a great point that you make. In addition to paying yourself, put the tax money away, because you might make a big deal in February and, the taxes aren't due for 14 months.
Yeah.
Don't be scrambling. Don't be scrambling when the taxes are due. Yeah. And so I've always tried to do that as well, obviously. But yeah, that was the early 90s. We did Metroscan, what is now LandVision, and CoStar was some floppy disks on green screen. It was C/Metroscan, and you'd have to change disks. There were still days that we'd have to go down to the county recorder because all the stuff wasn't up. And that's been a huge change in the business, right? We used to be the gatekeepers to information, and we'd wait around on Friday afternoon for the paper MLS to come out, and you'd get it. And then you'd want to be the first guy to get to the developer or investor with that information, right? We controlled the flow of availabilities. We don't do that anymore. The availabilities are available for anybody 24/7. I mean, you might have some advanced information. What we have is the way to analyze that information, right? What are the next 3 lease comps that are in the pipeline? And what's that going to do to the value of this property? It's, by the way, there's going to be a 10% uptick in lease rates. I can see it coming. Nobody else can see it. But here you should put this into escrow because you're going to benefit from it, right? The value is going to increase and people don't see it yet. That's different than what it was like 30 years ago. It's a different skill set, that's required to do it today.
Yeah. And those are, just for my knowledge, that's the Cushman Wakefield, like internal leases that you guys see coming down the pipe. It's not like there's another platform that you guys are pulling.
No, it's not a platform, and they may not be Cushman and Wakefield leases. This is me being in the market. They may be leases that I'm doing. They may be leases where we've received an RFP at a building and we're not going to get the deal, but I know the building down the street and I know what they're going to do. No, it's just being in the market.
In the market.
I mean, that's our role, is be in the market and have that information. But the information itself used to be enough, and now it's really the analysis, I think. And where's the puck going?
Yeah.
And that's what sets the people that I think are really successful apart.
Yeah. I want to pull on that in a sec, but I want to keep going back to this. So So when you were setting aside money, what were some of the things that you started, and when did you start looking to invest? Was the deal you alluded to a second ago, was that the first real investment that you got into?
That was the first real investment. We did that even before we bought a home. And those were 2 buildings, West Avenue 140th in San Leandro, California. A fellow had sold his janitorial business to one of the national distributors, and there were 2 side-by-side buildings. This was still in the wake of the 1986 Tax Act, and there was a lot of things in real estate that took 5, 8, 10 years to work out.
Yeah.
And so, this was 8 or 10 years after that. I think we paid $42 a foot for both buildings. And, 2 years later, we sold one of the buildings for what we sold them both for, and we were off and running.
Yeah.
And we continue. I don't think we've ever paid capital gains taxes on that. So it's now a portfolio of 12 or 13 properties in different places. We cash flow, quarterly more than our initial investment in that deal. It was incredibly successful. So the real estate was one thing, but early on, and I want to go back to that too, because what you do with the proceeds, I think, is important that come out, because you can't compound if you just spend that money. But one of the things, going back to where we started as a self-employed person, the SEP IRA is an incredible tool. I think it's $56,000 or $57,000 annually that you can put in, depending on where your income is. There are very few professions, that give you that opportunity because, generally we don't have employees. If you have employees and you're self-employed, you're obligated to put a certain percentage away for them, and that percentage can be a big part of their compensation. It's harder to do. If you own a trucking company and you've got 12 employees, it's harder to max those things out just the way the rules are set. But as a sole proprietor, or maybe you've got 1 or 2 folks working with you, it's easier to do that. The other tool, and I will admit to coming to this late, but I'm a huge proponent of it now, is a full-on defined benefit pension, which is something that if you're, in your career and you're starting to make some good money, you should be on your CPA about that. And if they haven't talked to you about it, you might want to find a new CPA, because that defined benefit pension is an amazing tool and allows you to make big contributions, even bigger than the SEP, depending on where you are age-wise and income-wise. So definitely tools that you want to look at.
What's just high level? So how does that work? How does it operate? You put money into it tax-free and you get taxed when you take it out, or is it the opposite?
You put money into it tax-free and you get taxed when you take it out.
Okay.
And once it operates, and this is not tax advice, once it's been in place for 5 years, you can convert it to an IRA. And it's still taxable when it comes out. I mean, I would assume that most of the folks that are successful that are listening to you, and I would think most of the people that are listening to you are successful, they wouldn't be interested in this stuff. You're past the Roth, right? Because you just blow through the limits and you can't do it. So I haven't found, I'd love to find something that we could, take out tax-free, but I haven't seen that yet. It really works like a SEP. It just has higher limits. You do need an actuary to calculate how much you can put in based on rates of return and different things, but it's fully deductible, and it can be a great deduction.
Yeah. So you put in anything that it makes is also tax-free while it's growing in there. You can just come
and it's all tax deferred. Yeah.
Tax deferred. Yeah. Sorry. Yeah. Okay. Great advice there. I will be chatting with my CPA. It's a good.
Yeah. No, it's definitely worth it. And then, maybe you employ a family member, which is also worth asking a CPA about. And, maybe they're doing marketing work for you or other things. So it's all worth looking at.
Have you done, with your investments, have you done any 1031s?
We've done dozens of 1031s. Okay. And that's so defined benefit pension, Roth, SEP, the 1031 is, it is the most incredible wealth creator, that's available to us in our industry. And I don't think we've sold anything and paid the taxes on it. I think we've deferred everything. I was in one LLC where I didn't have a lot of confidence in the sponsor after watching them in action going forward. where they did a drop and swap, and I took the proceeds out. Beyond that, now I'm in some investments that, that's the business plan is we're going to buy it and sell it. I'm really not a huge fan of that because of the tax hit that you take. So yes, we've done a lot of 1031s, and it's just a fantastic tool.
Yeah.
We're proud to be sponsored by Ridgeline Investment Group. Ridgeline has a track record of transacting more than $53 million in assets throughout Texas. Ridgeline is currently looking to acquire 100 to 200 unit Class B multifamily communities between 5 and 20 million in San Antonio, Temple, Waco, Tyler, and other Texas secondary markets. To learn more about Ridgeline Investment Group, visit www.ridgelineig.com.
Yeah, you'd mentioned something, so kind of keyed in on this, and it may be a question that other brokers, agents, anybody who, because it has been brought up previously with other guests that I've had on. When you went from straight brokerage services side of the business to also being an investor and the ownership side of the business, was there any concern on your part, or did it ever come up as an issue where you might be a competitor in the market space? And
it's a big concern. Yeah. Okay. And it changed the way we invested, honestly. Yeah. So when we started in the 90s, we were in markets that our institutional clients had no interest in working in. And so it was relatively easy to do because, you don't want the person on the other end of the phone saying, hey, if you're calling me, this must mean that you passed on it, right? And I've heard that said about other brokers in the market. You don't want that reputation. Yeah. You can't do good work. So we don't own any industrial in the markets that we work in anymore, which is great from a client point of view. One of my partners is a broker at another firm, and that's great from a client point of view and a conflict of interest point of view. It's not so great from an investment point of view, right? Because when we started, there were probably 10 or 15 people on the entire planet that knew what we did about our little slice of real estate, right? From the Bay Bridge in Oakland to, the San Mateo Bridge in Hayward, there just weren't that many people that knew what we knew. We saw everything that moved. And because we didn't have, the big REITs that came in later, we could move pretty comfortably. But we have sold everything now in California. Some of that was diversification off of the faults, because there is some risk, with an event, but we certainly didn't need to move everything out. Some of it is a chase for yield, right? Yields in California got super low. Much of it is exactly what you speak to, is the conflict of interest. And that's something you need to balance because, after your first couple of deals, there's an instinct, I'm a real estate investor now. Well, that's great, but you need to then live off of the cash flow, and you really want to reinvest that cash flow, because in the end, while we've had a great however many decade run here, and you could continue to refinance and pull cash out, it's not going to be like that going forward, right? The real estate is measured by the cash flow that it can produce, and if that's the case, and you're going to have minimal or no capital appreciation, you better be reinvesting that cash flow back into your business. Now, maybe it's back into real estate, maybe it's back into an S&P 500 fund or something more sophisticated if you've got a bigger portfolio. But that's important. So if that's the case, you need to keep your brokerage business going. And you've got to be careful not to be knocking heads with your investors, or you'll find yourself with no brokerage business.
Yeah. No, that's immediately why I keyed into it. And there was a thing, because we've been on the investor side more than the brokerage side ourselves. And we always just had the conversation like, we understand, but we understand you can get X, but we're going to pay you this much. And we're very clear, right? And so that's why you just have to be very upfront and open.
Well, there's that side of it too. And, even in those early days, you really don't want to buy something where you have the listing or you've even given advice. Like, you've got to separate that out. And, you want to keep telling people that first deal that we talked about, the fellow who sold it had some really good reasons to sell. It was a horrible story. He and his partner had sold the business, and 6 months later he lost his partner. That's how life is, right? It's like suddenly he's gone, And, I think 5 or 6 times I sent him in writing, and he finally called me and said, damn it, will you stop telling me? I know you're getting a good deal. I've just had enough of this. But you almost need to tell people so many times, hey, I'm an agent. Hey, I've got knowledge, until they go, stop it. It's like, okay, I made my point, because you do have to be careful. Yeah. And you don't want the reputation of taking advantage of people as you go through that process.
I agree. Okay, great point. So a couple of things. You touched on office. I'm very curious. The market that you're in, I mean, I hear all about San Francisco and how bad the office market is there currently. There are things that are happening there. So kind of curious on that front, if you know the brokers that are in that space and kind of like what you're hearing. Is there a play on any of those to turn them, to convert them into anything else? Because that could be telling nationwide sort of deal.
Yeah. I'm not an expert, right? I stay in my industrial lane. Yeah. But this idea of conversion sounds really good in the press, but most everybody that's listening has been to Manhattan Midtown and seen those spindly towers that have gone up. And just think of the floor plates in those, and there's a reason that they do the floor plates that day. So that way, now go into a downtown anywhere without speaking to a specific market, and you've got floor plates of 30 or 40,000 feet. Imagine breaking that up into, 1,500 square foot apartments, which is a big apartment. You're going to end up with a bowling alley that might have a window in one room. You're going to have a huge load factor, and you've got to be able to get that building at a basis that makes sense. And we're beginning to see the reset on basis. I mean, everybody, we've seen some really aggressive trades in San Francisco, not so much in Oakland where I sit. And so there is that basis reset going on that may make the economics of doing that better, but I don't think that's going to be the answer. I do think that there is a desire for people to be back in the office. I think we worked, in the first year of the pandemic, people were super excited, but your team was established. There was a culture. You weren't onboarding new people. Over time, the culture of your firm gets lost. And I think that's why you're seeing all these CEOs say, you got to get back to the office. What's it going to take? We went in the late 90s. I remember I was still at Grubb & Ellis. It was just before I came to Cushman and just before the .com crash. And we had a guy come speak to us, and he was the classic tech guy. He knew not only his business, he knew the future. And he walks into the room, and we're all wearing suits and ties because that's what you did. He goes, "You guys, suits and ties," and the next day, all the ties are off in the office, and everybody's like, "Whoa, man, I'm missing the future here." And then the bust comes, and all of a sudden, everybody's back in the office with a tie on, right? And so we may never bring back the necktie, although there are some people that are still wearing them out there really well. But when we get a serious recession, and you're going to lay people off, and you're based in San Francisco. I mean, what do? You go, "Oh, where's Susie? Oh, she's in Montana." Okay, well, Susie's gone, right? So you're going to start to see people, I think, come back to offices when they're concerned about their jobs or they're concerned about promotions. So, I think people will come back, and I think that's going to eat up a bunch of the space, but it's going to take a little time. I mean, this, and it goes back to what I said, about the early 90s. This really feels a lot like that. There was huge vacancy. There was huge vacancy after the .com crash. It wasn't as bad after the great financial crisis, but, San Francisco in particular is a boom and bust city, right? Its DNA is gold rush. It's a gold rush city. And there's a hell of a lot of smart, ambitious people here with a really good ecosystem that allows people to fail and try new things and fail, and it's almost a badge of honor. And you don't find that everywhere else. So, I do think it comes back, but I don't think I don't think we'll be talking in December and say, "Oh gosh, vacancy's down to 10%." There's work to do.
Yeah,
sure.
Yeah. So no talk. I've heard a lot about converting to apartments, but there's no talk, or you've not heard of anybody talking about industrial or turning some of these buildings into like data centers or anything like that. That's not a topic of conversation, because then
it's not a topic of conversation. I mean, there's just, a data center shell, when it's done right on the West Coast, it has to be seismically so robust and, certain dimensions to accommodate the racks. And we have seen conversions in downtowns. There are definitely some good examples in San Francisco of data centers that were done. But it's it's the exception, right? We might be able to take 10% of the stock and convert it to this and that, or even take it down and build something else. But, in the end, the economics, I think, and the way that it's built call for it to be office. Yeah.
So COVID obviously had a big impact on industrial. We can shift into that a little bit. Like on the tail end of that, how are you seeing the market shift now? Because to me, there was a big push for supply, right? Coming on market, right? So where is that shift right now?
Well, I think there's a bunch of different threads that weave through that. That the COVID in industrial was the greatest time in industrial that I've seen. And I've never worked so hard as I did in 2020, 2021 and into 22. And it was great. And it was great for people at, a certain point in their career. You weren't asked to make a presentation. You weren't asked to, do anything but, hey, I need help. And that was really the kinds of calls we were getting in 2020. Hey, I need help. And this is what I need to do. And that worked. It didn't work for those that didn't have established relationships and books of business. But the result of that, I think we pulled some of the demand forward, definitely. And so for the true operating companies, the Amazons, the FedExes, it pulled some demand forward, and there have been some slowdowns that they've all talked about publicly. And then you also had really, really cheap money. And so that money allowed, some companies that maybe didn't have the revenues in place yet, but there was plenty of investment capital out there. We've lost some of those groups, and so it's brought some sublease to the market. The sublease that's ready, that has office and dock equipment and lights and is ready to go, has been leasing, and it's been leasing at really, really good rates. But that space that isn't ready, because I think people are deferring decisions, and so when they decide that, hey, we don't want to make this investment, but we have to, they might only have 90 days left. And these days it takes 6-8 months to, get your permits and build something. And it might take you longer to get electrical switch gear, even to put inside the buildings. So if we stay static and we stay where we are right now, this feels to me like 2017, 18, the Northern California markets have never been super deep. Your tenants in the market list is never greatly exceeds the amount of supply that's out there. But then the third part of that is that the supply is going to dwindle a little bit, I think, even with the sublease, because the economics of building a building today are really difficult. And, it starts with interest rates, of course. Construction financing can run now to the double digits, but also goes to your terminal cap rate. Where before you might be projecting, if you wanted to build to a 75 basis point spread and you believed in some of these infill markets, you could sell out at 3.5 or 3 3/4. You might be developing to a 4.5. And you also had rent growth. And so you projected rent growth forward, and there are a bunch of things. Now nobody's projecting rent growth forward. Instead of a 75 basis point spread, they might be building, if they're building, to 125, 150, because they don't know if cap rates are going to go higher. So that they're building in a much bigger margin for error. And that's taken land prices that were close to $100, well under 50. We really haven't seen that many trades. So that's great, because we go into this thing with a 2 or 3% vacancy, and you're not going to see a lot of new product come in behind it. So even if we wash out some folks, through failures, and they give back space and sublease, real estate isn't leading this, in terms of being overbuilt the way that it has in other downturns, where you go into a downturn at 8 or 10% vacant. It's only going to get worse from there. So I think that is the silver lining. And so far, the tenant flow is good. It's not obviously what it was. We may never see that again. I mean, we saw a moment in history that was unprecedented in terms of the demand that was out there.
Yeah. A buddy of mine, he got into the space a while back, and he's out of Houston, but they run a fund, and he's been buying a bunch of stuff. And so seeing his track record, seeing how they expanded and kind of blew up during that period, it was an impressive. So knowing that, where do you see, like, if someone new is trying to get into industrial right now, or if I'm looking to invest in a project that somebody's doing, where would you say there's opportunity right now to put some dollars to work?
Yeah, and I've always been opportunistic when I look at investments and not programmatic, if that makes sense, right?
Yeah.
So I personally, I'm not running a fund, so I don't need to go out and deploy money every month or every quarter. And so if you are a broker in a market, there may be, and that's the beauty of our business, it remains inefficient, right? And sometimes, it might be the residential broker who has a listing with their neighbor, and it's gotten a little bit harder because it goes on LoopNet and a lot of people come in, but they put it out and they just put it out at the wrong number, and you're able to come in and pay cash. So that might be an example. It might be somebody that has to exit, and we are going to see some stress. Loans are resetting. Even if you don't need to seek a new loan, you may have a reset. And that reset from 4 to 8 or 9% in some cases is pretty brutal, and what it's doing. So it might be there. One of the things that I've been lucky to do over the last 30 years because I'm in the business is meet folks who I think are incredible sponsors, who are still out there looking for deals. And, that because I am running a brokerage business and doing a lot of things, I can't operate, assets day to day at any kind of scale. So, I listen to every sponsor, and, people say, oh, but the fees, look, if you're paying the sponsor who's running your deal a 30% or 50% waterfall, that means they made you a hell of a lot of money, right? So, you need to get over that. And, maybe you could do it yourself, but maybe you couldn't identify the deal that they identified, and maybe you couldn't or don't want to, do the heavy operating lift that's out there. So,
so on that front, because again, I deal mainly with multifamily, I see a lot of decks that come out, a lot of OMs and that sort of thing. So what is there, maybe not a standard, but is there typically a return profile that some of these deals are kicking off, that if I picked up any kind of offering coming out from a seasoned sponsor and they're like, hey, here's a deal, what could I expect? 10% IRR? Are we going 20? Are we going, it's not a development deal? Or
right.
You tell me.
Well, I mean, it's all over the map on what they project. And I'm always a little,
I know it's a hard
suspect on the projections. I'm always a little suspect on the projections.
Okay. Yeah.
But the first thing is, who's the sponsor, right? And I always, I don't know if it's appropriate to say this, but I have something called the widow test, right? And so before I even look at the economics, I'm not in the room, and it's my wife or one of my children who doesn't know anything about real estate, and they do know, some things, but they don't know what this person knows. So you just want to make sure that you're dealing with somebody, because you're going into long relationships with these things, right? And I've been in some that, they don't all work, right? Like every real estate deal that you get into does not work. And when it works, everybody's a genius. But when it doesn't work, you want to know that you've got somebody who's in for the long haul. Yeah. I like to see my partners have their own equity in the deal, because if it's only a promote, and that promote is gone, it's awful hard, unless you've got a really strong sense of duty to necessarily work on that the way that you would if it was your own capital. So I'll look at that. But what am I seeing? I got an apartment offering the other day, and it was a 7% pref, I think 1% asset management fee, and they were projecting a 19% IRR. It was a reposition, the family-owned long-term. That seems to be the common thread in multifamily, right? Family-owned long-term opportunity to manage it up.
Yeah.
And, maybe you can do that, but there is a limit. It gets expensive because the tenants in place are probably not your new tenants. There's a reason they were in there paying the lower amount. The rent goes from $800 to $1,400. You probably need to roll the whole thing over. Yeah. So then there's all the capital that goes into it, and it gets expensive. So, but those are the kinds of deals on the multifamily side that I'll typically see. And there's a couple of people that I know that I really like and trust, and always willing to hear them out on what they're doing. But yeah, more and more, I'm interested in what kind of rent can it spit out versus what's the upside on the capital, because I don't think we're done yet on the adjustment. I think we've seen adjustments on people's acquisition prices, but as loans roll over and people need to exit, I think there's, in every asset class, I don't think we fully understand what this increase in interest rates that was so fast is really going to mean.
Yeah, no, I agree with that. And so are you actively looking to place capital in deals right now? Or are you kind of, I'm on pause and waiting to see how this works out?
Well, it goes back to opportunistic, right? And so what else is coming? I have a spectacular financial advisor. He has given me some opportunities to look at some distressed debt funds and other things that, you go in just as a limited. And so you kind of have to make your choice. And frankly, probably a good time to build up some cash reserves against the investments that you already have, because you don't know what might be coming down the pike. Your vacancies may be longer, and, there may be better deals, down the road a little bit too, if there is indeed a reset. So I don't wake up in the morning looking for things, but if something comes and it looks like it makes a lot of sense, we'll take a look at it.
Yeah, great. Well, I think that's great advice. I mean, the conversation's kind of gotten to a natural ending point. I think. I mean, it's one of those things. For me, I'd like to talk to you about deals. I don't know if you want to talk about a deal that you've done, like one of your biggest transactions, one of your hairiest transactions. But that's up to you if you want to discuss some of that stuff and kind of go down that road or not.
Well, the hairiest transaction was probably one that we bought from a well-established developer in a trade pretty early on, and it was on a developing on a row, and we messed up. We didn't understand that as we went to redevelop or do something with the property, that the plan line for the street was going to widen out, and it was going to take the first 20 feet off our building, right?
Yeah.
So immediately when we turn over tenants, that's what's going to happen, because they're not going to be able to get an occupancy permit, and we have to fund it. And so we were at a little bit of a loss, but because it was on a developing on a row, and this is back when the redevelopment agencies were putting money into auto dealerships. It's the way that sales taxes in California are gold for the municipalities, because they get to keep a good portion of it. Yeah. And so they would use these redevelopment funds before Jerry Brown took redevelopment away to do these developments and attract things. So we ended up working with a local auto dealer who was working with the city to bring him in. They actually overpaid to buy us out of the property so that he could do his auto development. And then we got to do something called a 1033 exchange. Have you ever done a 1033?
I have not.
So when there's what's considered a taking, which is what the redevelopment was, we had the city write us a letter that, if we didn't do this, they might take it by eminent domain, and eminent domain was still in place. It actually gives you 2 years, and you get to keep the capital in your own bank account. You don't have to go through an accommodator. So you had all kinds of time to look for a deal. It turned what was a real failure of due diligence on our part into just a home run on how we got out of it.
Very interesting. A home run, plus you've learned about a 1030.
We learned without getting hurt, which is great, because most of the time to learn a really good lesson, you have to get burned a little bit. Yeah. We did another one around that same time, and this deal, the upleg that we bought turned out to be an absolute home run. This is when we were doing deals in our local market. So it's probably, I guess it was 2003, 4, 5. We did a reverse exchange, right? So we then had a year to sell our down leg, but somehow word got out to the market that we were doing a reverse exchange, and tick, 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 like we're starting to run out of time. And, people are running at us, trying to make ridiculous deals. And that was really scary. So, if you're going to do a reverse exchange, make sure that the upleg is a screaming deal, right? That's the only reason you want to get into it. And then make sure that nobody knows that you've got a reverse exchange, because you'll make yourself so vulnerable when you're sitting out there. So,
Can you touch on that? Okay, so you identified the asset first that you wanted to acquire.
We identified the asset. We didn't have the capital, but we did have equity that we built up in this other property.
Okay.
And so it was First Republic Bank, back when First Republic Bank was a small local bank, and they knew us and they would do anything. And we missed them a lot. They were amazing. And so they gave us a credit line against the other property, and we used that credit line for the down payment. And, there were some, number of restrictions on what we could do. They cross-collateralized it. And so we bought our up leg, and then we had a year to perfect the sale of the down leg on the closing. And that's how we structured it. And I don't know if you'd find a bank to lend to you that way today. But it was a neat way to know where we were going. We knew the other asset had pretty much matured and was ready to sell.
Yeah. So how'd you get out of the down leg? What happened?
We ended up selling it. We ended up selling it to a user. And we ended up with pretty good execution. But, as the clock ticks, that's a year isn't a long time to do a good real estate transaction, right? You can get into contract and it takes you 3 months to market it, and you get in with the wrong party, and, they don't kick out. And, now you only have 6 months left. And so the next one that you choose had best be the right one.
Yeah.
And sometimes that comes at a cost or price. And if they understand what you're up to, when there's 45 days left and they come back for that retrade, it's okay.
You got to do it. Yeah.
Yeah. You do it. So I don't think I would sign up for a reverse exchange again, but it was certainly an interesting process.
Yeah. The 1033 is interesting to me because we just had a parcel here in San Antonio that the city came and they were condemning it because they needed to put in a drainage ditch or something, right? And so they took a large portion of this tract that we had, and I didn't know you could do that. So yeah, it looked like a sale essentially when we took the funds.
And I think now that was a bunch of years ago, but I don't think it's changed. I think the 1033 is still in place.
Yeah, that would have been good info. So I just learned that. I appreciate the knowledge. Thanks for doing that. All right. Well, John, it's been great having you on. I appreciate you jumping on, sharing your knowledge. I definitely agree with the early information about stocking some money away, making sure that you're paying yourself first. So if you're not doing that, please take the advice and do that. If you want to reach out to John, his contact information can be in the show notes. So by all means, reach out to him, see what he's working on. Thanks for jumping on.
Okay. Thank you. Have a great day.
Have a great day.
Bye-bye.
Bye.
Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.